Hello, and welcome to Crescent Private Wealth's March 2026 Market Update. My name is Omar Bassal. Today we'll be looking at the following topics. We'll begin with a discussion about economic news in the U.S., followed by a discussion on interest rates in the U.S. We'll look at U.S. stocks, then we'll look at non-U.S. stocks, and finally we'll end with some commentary on the war in Iran. So, with respect to economic news, in the month of February, the US economy lost 92,000 jobs. This was worse than market expectations of a gain of 55,000 jobs. The unemployment rate came in at 4.4% for February, which was weaker than expectations of a 4.3% unemployment rate. And then, in terms of economic growth or GDP growth, gross domestic product, for the fourth quarter of 2025, the growth rate registered at 0.7%. Now, this was actually revised lower from earlier reports of a 1.7% growth rate. So, the kind of sum total that we're seeing is that the job growth is negative right now. The economic growth was a little bit weaker than expected, and revised lower than what had initially been reported. Now, the revisions are very normal, but obviously this is a pretty big revision to go from 1.7% growth rate to 0.7% growth rate. So this particular chart is showing you the new home sales annualized rate from actually going back for a couple of decades here. And what I really wanted to just highlight here is that the new home sales that was released for February had fallen to a 3.5-year low. So we look at new home sales and building permits and these residential data because it's such an important part of the economy and because it's sensitive to economic growth. So when we see kind of weak new home sales, that doesn't kind of confirm the information we've been looking at in terms of the job growth and economic growth. It obviously also reflects that interest rates are higher than they were, for example, in the 2000s or right after COVID when the interest rates were almost 0%. The mortgages that were taken out were much lower than they are today, and therefore people are hesitant to sell their homes and having to refinance, for example, at a higher rates. So you do have new home sales being relatively weak. Let's look at interest rates. So the inflation report for February was released, and it showed that the inflation numbers grew. The inflation rate was 2.4% annual rate. Now, that was, decent, but what I would caution is that the future inflation reports are going to probably be much higher given the war in Iran and its effect on, for example, energy prices. So prior to or in February and before February, the markets had expected that the Federal Reserve, the central bank in the US, would cut interest rates maybe twice in 2026. Given the war with Iran and given the effect it's had on, for example, gasoline prices, there's now an expectation of there might be one rate hike in 2026. It's not certain, but markets have changed their expectations given the inflationary data that we expect to see soon. So this is a good measure or a good way to look at why inflation is going to be higher in the future. This is showing you the average price for a gallon of gasoline in the US, and this goes back for about a year. It goes back for 12 months, and you can see here that it was relatively low and stable, and then when the war with Iran kicked off, it just effectively in about 3 or 4 weeks jumped $1 per gallon, and that's a big hit for a lot of commuters and a lot of transportation, and therefore you should expect to see that future inflation reports are going to reflect that higher prices that are being paid for energy. Another indication of that in the market is expecting higher inflation is just looking at the yield of the 10-year government bond. So there's a big drop down at the end of February where the 10-year government bond yield had fallen below 4%. And then, of course, in March, when the markets first responded to the war with Iran, you can see how that rate just skyrocketed from less than 4 to approaching 4.5. So That's a signal that the markets are expecting higher inflation. Higher inflation means higher interest rates, and obviously higher interest rates affect things like home purchases and affects car purchases and many parts of the economy. Let's look at US stocks. So, US stocks had actually been pretty much flat through the end of February, like in other words, from January 1st, 26 through into Feb 26. The US market had been kind of flat, but once the war with Iran began, you started to see some weakness in US stocks. A lot of the corporate news that's been released has kind of been overshadowed by the events that are happening in Iran and the increase in energy prices, the increase in fertilizer prices, how those will impact consumer spending and economic growth. So what that means is that companies might report very good information, good data, but markets are kind of more focused on the inflationary impact of the war, and therefore stock prices might still fall even if there's good news being announced from specific companies. So this is the a chart of the S&P 500 index, and this pink line is just the 200-day average of that index. And so you can kind of see here at the far right that um, given the weakness we're seeing with the war, US stocks have now fallen actually below that 200-day average. So it's indicative of a correction. And then just the duration, the extent of that correction is really tied to the war. This shows you the best performing sectors in the US market so far this year. So it should maybe be no surprise that most of the sectors are negative, but there's one standout sector, and that's the one on the far left, energy. You can see here that for the year to date, from the beginning of the year through March 23rd, the energy sector is actually up 33%. It's up 7% alone in the month of March. And then you can see pretty much every other sector has been negative. Well, every sector is negative for the month of March. And then you have a couple of them that are still positive for year to date, such as utilities or consumer staples, which are clearly sectors that their demand does not vary by the economy. So, the amount of toothpaste that you buy or the amount of, when you're heating or air conditioning your house, typically you don't really vary it based on the economy. So therefore, that's why you're seeing that those stocks have outperformed the rest of the market. For example, like if we look at technology, which is down 7% from the beginning of the year, or financials, which are even down worse, 10%. Let's look at non-US stocks. So the performance of non-US stocks this year very much varies by region. So countries in the Middle East, for example, and Europe, and major energy importers have performed worst. And so that's what you would expect. Those are the countries most impacted by the war in Iran. However, other countries have done well. So South Korea, Taiwan are heavily tied to the AI, artificial intelligence spending boom that we have discussed in prior months. Norway is done well given it's an energy exporter. It has a lot of oil. Some Latin American countries have also done very well. So let's kind of look at a chart here. This shows you the performance of major international countries from January 1st of 26 through March 24th of 2026. So if you look in that far left, you have South Korea, Norway, Turkey, Brazil, Peru, Thailand. Some of these countries are let's say less impacted by the crisis in the Middle East. If you look at the far right, you're going to see countries that are more impacted, who might be importing a lot of energy. So for example, India imports a lot of energy from the Middle East. The performance of Indonesia is somewhat tied to a separate issue that they're running through regarding their inclusion in indexes. So that's why it's done the worst. But if you look at some of these other European countries that are shown there, Germany, for example, Czech, for example. Now, South Africa has done very poorly because of its heavy exposure to precious metals, and precious metals have not done well in this environment because of the effect that rising interest rates has on the performance of precious metal prices. Let's have a few comments about the war in Iran. So the war in Iran has occupied investors' attention because of the closure of the Strait of Hormuz and the damage to major energy infrastructure in Gulf countries. So even if the war ended tomorrow, the amount of energy flowing through the Strait of Hormuz would likely be much less than pre-war levels because of damage to infrastructure in many countries in the Gulf, Saudi, Kuwait, UAE. They've all been damaged by the war. So It's just not, it's not only the strait, but the damage that's been done to those infrastructure. Qatar has had huge damage to its infrastructure. While most of the energy exported through the strait goes to Asia, the blockage has resulted in an increase in prices for all consumers. So it's not the case that just because most of the buyers of the energy coming through the strait are in Asia, therefore it doesn't affect Europe or the US. Because at the end of the day, if Asia doesn't get its energy, it doesn't simply just, have a fast from energy. It needs to buy the energy from somewhere else. And therefore it will compete with others for that energy. So it's a global market. Therefore, the reduction of energy through the strait affects everyone, not just Asia. It definitely affects Asia more because they were getting direct shipments. And so if you're getting direct shipments from the strait and you're no longer getting it, now you have to find your energy from somewhere else. Or you have to look for alternatives like coal, or you have to start rationing energy, which there are countries that are simply, they don't have the means to buy the pay the high prices, and they're going to have to tell people to, restrict their uses of electricity, have 3 or 4 day work weeks, prioritize who does get fuel. There's a limit of how much gasoline you can pump. These are all measures that are being implemented as we speak. While there have been promising overtures towards peace from the US, it's not clear that Iran or Israel, for that matter, will agree to end the war without major concessions. So, if you've followed some of the news and you look at the demands from the US versus the demands from Iran, they're just like completely different planets. There's almost no overlap. So, the US is saying zero enrichment of uranium, and Iran is saying we must have enrichment of uranium. And the US is saying, in your support for any proxy groups, and the Iranians are saying that's non-negotiable, and the US is saying like you have to open up the strait, have freedom of movement in the Strait of Hormuz, and Iran is saying we now control the Strait of Hormuz. So unfortunately, usually if you don't have settlement and negotiations, it continues through war until one of the two sides gets tired of the war and is unable to continue, and then some kind of agreement is made. So this just shows you how important the Strait of Hormuz is. So, as an example, 38% of all seaborne crude, all the crude oil that's transported through the sea, through waters, is goes through the Strait of Hormuz, and liquefied petroleum is 29%. And like propane, for example, like these are, if you've ever been in a country where people will have these their kitchen will be, using these big canisters to be able to cook, for example. You have, for example, liquefied natural gas. It's used for electricity. Refined oil products, it's around 20% of global refined oil products passes through the strait. So clearly massive amounts. It's the artery of the world for energy. There's no more important waterway or passageway for global energy than the Strait of Hormuz. And this just shows you, it breaks out the amount of shipments that are happening on a daily basis from end of Feb through March 22nd, and it breaks it out by liquefied natural gas and liquefied petroleum, crude tankers that carry crude oil. And you can see here how basically once the war starts, that number just goes to not zero, but near zero. And so, this is a major problem. And until that recovers, you're going to see continuous pressure on pretty much all energy prices. And effectively, once all energy prices are going up, that feeds into other goods and services. Because if you're buying some shirt from a store, that shirt had to be on a truck, or maybe it got or was transported through a ship, and so it's going to have a component of energy cost to it. So there's pretty much nothing that we use is not even, the energy from your house. Everything has some component that's going to be affected by this. So hence the importance of this war with respect to financial markets. So we all hope, God willing, that this ends soon and that things can return to normal. And we thank you all for taking the time to listen to our presentation, and we'll be with you next month to update you on developments as they occur. Thank you.